There is a quiet, steady leak coming out of the retirement finances of most Americans over 65, and almost nobody talks about it because it doesn't show up as a bill in the mail. It shows up as a refund that is smaller than it should have been, a deduction that was missed, a credit that was never claimed, a filing status that wasn't updated, a bracket that wasn't optimized. Each year, billions of dollars in legitimate tax breaks for older Americans go unclaimed. Not because people are not entitled to them, but because they simply don't know these breaks exist. The number you often hear is that only a small fraction of eligible retirees claim the full set of age-based tax benefits available to them. Various analyses put the number at roughly 1 in 9, which is where the 11% figure comes from. Whether the exact figure is 10% or 15% in any given year, the underlying point stands. The vast majority of people over 65 are leaving real money on the table every April, year after year, decade into decade. This video is for educational purposes only and is not personalized tax, financial, or legal advice. Consult a qualified professional for guidance on your specific situation. What I want to do today is walk through 6 of the most commonly missed tax breaks for retirees over 65. Not exotic strategies, not aggressive positions, just standard, on the books, in the Internal Revenue Code provisions that Congress built specifically to support older Americans, and that most eligible retirees never think to claim. The first is the additional standard deduction for age 65 or older. This one is hiding in plain sight on your Form 1040, but a surprising number of retirees don't know it exists, especially if they have used tax software for decades that automatically calculated it for them, and they never looked at what was happening underneath. For tax year 2024, the standard deduction for a married couple filing jointly is $29,200. If both spouses are 65 or older, each gets an additional $1,550 deduction, bringing the total standard deduction to $32,300. For a single filer, the standard deduction is $14,600, plus $1,950 if you are 65 or older, bringing it to $16,550. If you are also legally blind, there is an additional amount on top of that. The practical effect is that a married couple where both spouses turned 65 gets roughly $3,100 more in standard deduction than a couple under 65 with otherwise identical finances. At a 22% marginal rate, that is about $680 less federal tax per year. Across 20 years of retirement, that is about $13,600, just from one box being checked correctly on the return. The IRS knows your date of birth from your Social Security number, and most tax software applies this automatically, but if you are filling out a paper return, or if you are a surviving spouse whose filing status changed, confirm the additional amount is applied. The second is the credit for the elderly or the disabled, which is computed on Schedule R. This credit is relatively narrow in its income limits, which is part of why it is so often missed. It applies to taxpayers aged 65 or older, or retirees under 65, who are permanently and totally disabled and receiving taxable disability income. The income limits are low. For a single filer 65 or older, adjusted gross income generally must be below $17,500, and the non-taxable portion of Social Security and certain pensions must be below $5,000. For married filing jointly where both spouses qualify, adjusted gross income must be below $25,000, with non-taxable income below $7,500. The credit itself is modest, up to roughly $1,125 maximum in most cases. But for retirees in genuinely modest circumstances, it is real money, and it is almost never claimed by those entitled to it. The eligibility form is simple. Schedule R attaches to Form 1040. If your income is low enough, running through the eligibility test takes 10 minutes and may produce a meaningful credit. The third is the higher threshold for medical expense itemized deductions. Medical expenses are deductible on Schedule A to the extent they exceed 7.5% of adjusted gross income. This threshold used to be higher for taxpayers under 65 and lower for those 65 and older, but the Tax Cuts and Jobs Act aligned them at 7.5% for everyone. which actually helped older taxpayers who had been at a higher threshold briefly. The important thing for retirees is that medical expenses often include things people don't realize are deductible. Medicare Part B, Part C, and Part D. Premiums. Long-term care insurance premiums up to age-based caps. Dental, vision, hearing aids and batteries, prescription drugs, home modifications for medical purposes, like grab bars or a wheelchair ramp, mileage to and from medical appointments at 17 cents a mile for 2024, assisted living and nursing home costs when primarily for medical care. Linda, a retired accountant from Michigan, had been using the standard deduction for a decade. When her husband was diagnosed with early Parkinson's and she started tracking medical expenses, she was surprised to find that between his long-term care insurance premiums of about $5,000, her Medicare premiums of about $3,200, their combined prescription costs of about $2,500, dental work of $1,400, and mileage to specialists of roughly $900, they had nearly $13,000 in medical expenses for the year. Their adjusted gross income was about $96,000, so the threshold of 7.5% was $7,200. Their deductible medical expenses were roughly $5,800. Added to state and local taxes, mortgage interest, and charitable giving, itemizing, produced a deduction about $2,400 higher than the standard deduction. At their bracket, that was about $570 in tax savings that would have been missed. The fourth is the Savers Credit, which actually can apply to working retirees. If you are still working part-time in retirement and contributing to a traditional IRA, Roth IRA, 401k, or similar, and your adjusted gross income is below specific thresholds, you may be eligible for the Savers Credit. For 2024, the credit is available to single filers with AGI below $38,250, head of household below $57,375, and married filing jointly below $76,500. The credit is a percentage of contributions up to $2,000 for a single filer or $4,000 for a married couple, with the percentage depending on your income. At the lowest income levels, the credit rate is 50%, providing up to a $1,000 credit for a single filer or $2,000 for a married couple. Retirees with modest income and part-time work often miss this because they don't think credits like this apply to older workers. There is no age limit on the Savers Credit. If you qualify on income and you made eligible contributions, you can claim it. Form 888 computes the credit. The fifth is the long-term care insurance premium, deduction. This one is genuinely complicated but potentially significant. Long-term care insurance premiums on a qualified LTC policy are deductible as medical expenses on Schedule A, subject to age-based caps. For 2024, the deductible amount per person is $5,880 for taxpayers age 71 or older, $4,710. For ages 61 to 70, $1,760. For ages 51 to 60, $470 for ages 41 to 50, and $150 for taxpayers age 40 or younger. These caps are indexed annually. For a couple in their mid-70s, both paying LTC insurance premiums of $4,000 each, $8,000 total, the full $8,000 is deductible, as long as they are both within the age cap. Combined with Medicare premiums, prescription costs, and other medical expenses, this often pushes retirees over the 7.5% threshold and into itemizing. Self-employed retirees have an even better option. If you have any self-employment income, in retirement, consulting, board service, freelance work, you can deduct LTC insurance premiums as a self-employed health insurance deduction above the line on Schedule 1, without the 7.5% AGI threshold. This is a much more favorable treatment and is worth structuring any part-time income around if you have LTC policies. The sixth is the Qualified Charitable Distribution, or QCD. If you are age 70 and a half or older and have a traditional IRA, you can direct up to $105,000 per year in 2024, indexed for inflation going forward under Secure 2.0, directly from your IRA to a qualified public charity. The QCD counts toward your RMD if you are subject to one, and the amount distributed is excluded from your adjusted gross income. The power of the QCD is not just the tax deduction, it is the exclusion from AGI. Because AGI drives Social Security taxation, Medicare IRMA thresholds, the medical expense deduction floor, the net investment income tax threshold, and various state tax calculations, reducing AGI is often more valuable than an equivalent itemized deduction. A QCD reduces AGI. A charitable contribution written as a check from your checking account does not. Richard, a retired electrician from Nevada, had been writing a $4,000 check each December to a veterans support organization. His CPA pointed out that restructuring the gift as a QCD directly from his IRA would reduce his AGI by $4,000. That AGI reduction kept him just below the first Medicare IRMA threshold. Staying below that threshold saved him about $720 in Medicare premiums the following year. Same charity, same amount, different pipe, better result. Beyond these 6, there are adjacent breaks that retirees should be aware of, even if they don't universally apply. The property tax circuit breaker exists in many states, providing property tax relief for older residents based on income. Requirements vary enormously by state. Ohio, Pennsylvania, Illinois, New York, and many others have programs. If you own your home and you are over 65, check your State Department of Revenue website for whether a senior property tax relief program applies. These can save hundreds to thousands annually. The capital gains exclusion on primary residence, commonly known as the Section 121 exclusion, is not age-limited, but it is especially relevant to retirees who downsize. If you have owned and used a home as your primary residence for 2 of the last 5 years, you can exclude up to $250,000 of gain if single, or $500,000 if married filing jointly. Downsizing retirees often forget to plan for the basis calculation, which includes purchase price plus improvements, plus purchase costs minus depreciation if the home was ever rented. The age 55 and over community and related housing decisions can have tax implications in some states, particularly around homestead exemptions. Not universal, but worth asking about. The early retiree healthcare deduction, or more precisely, the ability to use HSA funds tax-free for qualified medical expenses, continues into retirement if you have an HSA. HSA withdrawals for non-medical purposes are taxable, but if you wait until 65, they can be used for any purpose and are taxed as ordinary income, with no 20% penalty. Medical expenses from the HSA remain tax-free at any age. The Section 1998A qualified business income deduction may apply if you have part-time consulting, rental, or self-employment income. This 20% pass-through deduction is separate from the standard deduction and can produce meaningful savings for retirees with side income. Here is the bigger picture. The tax code contains dozens of provisions that favor older Americans, some explicit, some implicit. Filing status, standard deduction, credit thresholds, deduction structures, and withdrawal rules all shift as you age. Most of these shifts are favorable. Some require affirmative action by the taxpayer to claim. Very few are automatic. Why do so many retirees miss these breaks? A few reasons. First, most retirees filed their returns the same way for decades, while working, and the transition to retirement tax filing is genuinely different. Items they never dealt with, like the additional standard deduction for age, or the medical expense threshold, or the QCD, simply were not part of their past filing experience. Second, tax software can be both a help and a trap. It applies many of these breaks automatically based on date of birth, but it does not prompt you about strategic choices like QCDs or filing a part-year state return optimally. Software handles the arithmetic. It does not handle the strategy. Third, many retirees work with preparers who handle the basics but don't specialize in retirement tax planning. A volume preparer processing dozens of returns per week may not ask about LTC insurance premiums, QCD opportunities, or the saver's credit for part-time income. A specialist who understands retirement tax specifically will ask. Fourth, the rules change. Secure 2.0 alone added or modified dozens of provisions. The QCD cap indexing, the saver's match replacing the saver's credit in the future, the new catch-up contribution rules for higher earners, and the RMD age changes all matter. Keeping up with the changes is work. So what do? Start with your own return from last year. Pull it out. Look at your Form 1040 line by line. Confirm your standard deduction reflects the additional amount for age 65. Look at Schedule A if you itemized, and check whether medical expenses were fully captured. Look at Schedule R to see if the credit for the elderly or disabled might apply. If you have an IRA and you are 70 and a half or older, look at your 1099-R and confirm any QCDs were correctly reported with a Code 7 distribution minus the QCD amount excluded from line 4B. Make a list of every potential deduction source: medical expenses, state and local taxes, home mortgage interest, charitable contributions, long-term care premiums, property taxes, sales tax if you live in a state without income tax, casualty losses from federally declared disasters, miscellaneous itemized deductions that apply to retirees. Compare itemized to standard. Many retirees assume they will take the standard deduction, especially after the Tax Cuts and Jobs Act raised it significantly. For retirees with significant medical expenses, charitable giving, property taxes, and state income taxes, itemizing can still produce a better result, especially if you bunch charitable giving into alternating years using a donor-advised fund. Review your state return. State tax breaks for retirees vary wildly. Some states fully exempt Social Security. Some partially exempt pensions. Some offer age-based property tax freezes. Your state's Department of Revenue website usually has a retiree-specific publication worth reading. Consider a specialist review. If you have been using the same preparer or software for years, a one-time review by a CPA who specializes in retirement tax can surface missed opportunities from prior years. The look back for amended returns is generally 3 years, so if you missed something in 2021, 2022, or 2023, you may be able to amend and recover the tax. Walter, a retired machinist from Ohio, had been claiming the standard deduction every year. He volunteered as a rideshare driver for a local senior center, which his accountant had never asked about. Turns out the mileage was a charitable mileage deduction at 14 cents a mile, and he was logging about 6,000 miles a year. That was $840 in charitable mileage. Combined with the cash donations he'd been giving to various causes, about $2,100 a year, and his state income tax and property tax, he had enough to exceed the standard deduction. Amending 3 years of returns recovered about $2,200 in federal tax. It was not a fortune, but it was 3 rounds of groceries, a couple of utility bills, and the confirmation that the rules genuinely do favor people who track the details. The tax code is a conversation between you and the government about what you owe, and the conversation has a lot of rules. Most of those rules were written by people who wanted to support specific activities or life stages, including retirement. Not knowing the rules means you participate in the conversation with one hand tied behind your back. The encouraging news is that at any age, you can still learn, adjust, and claim what you are entitled to. It is never too late to fix a filing approach for the current year or the next return. And for many retirees, the back of the envelope savings from even 2 or 3 of the provisions we discussed today add up to hundreds or thousands of dollars annually, compounded across a retirement that may last 25 or 30 years. If you found this walkthrough helpful, here is a teaching suggestion. Print out your last tax return and highlight each line. Any line where you're not sure what's happening, circle it. Then take the circled items to a tax professional, or spend a focused hour researching them on the IRS website. The exercise takes an afternoon. The return on that afternoon of work over the rest of your retirement can be one of the highest hourly returns on effort you will ever earn. Tax literacy in retirement is its own form of income. And like every form of income, it is earned by showing up and doing the work. Good luck, be kind to yourself through the process, and I'll see you again soon.